Hello friends, are you planning to sell your main home? Then this video is going to help you understand some tax aspects of selling the house. So here are 5 crucial taxation points on the sale of a house. 1. Capital gains tax. The first important point to consider when selling your house is the capital gains tax. When you sell your home for more than what you paid for it, the difference is considered a capital gain, and you may have to pay tax on that amount. The IRS exempts a portion of these gains for those who meet certain requirements. For tax year 2023, if you're single, you can exclude up to $250,000 of your gain from your income. And if you're married filing jointly, the limit doubles to $500,000. However, to qualify for this exclusion, you must have owned the home and used it as your primary residence, or at least 2 of the 5 years before the sale. This test for exclusion of gains on the main home is provided in Section 121 of Internal Revenue Code. It is noteworthy that you can meet the ownership and use requirements during different 2-year periods. However, you must meet both tests during the 5-year period ending on the date of the sale. Generally, you're not eligible for the exclusion if you excluded the gain from the sale of another home during the 2-year period prior to the sale of your home. Point 2. Reduce the cost of improvement and the cost of selling the house. A second crucial point to understand is that any improvements made to the property or selling costs can be added to the cost basis of your home, reducing the taxable capital gain. For instance, if you initially purchased your home for $200,000, spent $50,000 on home improvements, and incurred $10,000 in selling costs, your cost basis would be $260,000. If you sell the house for $500,000, your taxable gain would be $240,000. 3. Did you claim depreciation on the house? If yes, this point is important. If you've ever used your home for business or rented it out, you've probably claimed depreciation on your tax returns. Depreciation recapture is the tax on the gain realized on the sale of depreciable capital property. When you sell your house, you must recapture the depreciation and pay taxes on it. This tax rate is typically 25%, but can vary depending on your income. 4. 1031 exchange. If you're planning to reinvest the proceeds from the sale of your home into another property, consider a 1031 exchange, named after Section 1031 of the U.S. Internal Revenue Code. This allows you to postpone paying capital gains taxes if you reinvest the proceeds in similar property as part of a qualifying like-kind exchange. There are strict rules about the timing of the purchase and the type of property you can buy, so it's important to plan carefully. 5. State taxes on capital gains. Lastly, don't forget about state taxes. Depending on your location, you might need to pay state capital gains tax, transfer tax, or other types of tax on the sale of your home. State taxes can add significantly to your tax burden, so they should definitely be factored into your calculations when selling your house. However, if your property is situated in the following states, you may not have to pay any capital gains tax to the state: Alaska, Florida, Nevada, South Dakota, Texas, Washington, Wyoming, Tennessee, and New Hampshire. If you like this quick video on taxation issues related to the sale of a house, please subscribe to our channel and click the bell icon. Oh, yes, if you have any questions on capital gains on the sale of a house, write in the comment section.